Making the switch from being a W-2 employee to a 1099 contractor can prove to change your tax situation quite a bit. If you do nothing to plan for your taxes as a real estate agent, you will pay a larger percentage of your income to taxes, assuming that the income numbers are the same. In this talk, we're going to walk through how taxes work for a real estate agent and how best to minimize them so that you're able to invest more for yourself and your family. Now quickly, a disclaimer, nothing in this talk should be taken as tax advice because each situation is unique and requires a customized tax plan. So please understand that this was designed to be applicable to the broadest audience, and you should consult a CPA before making any tax-related decisions. Okay, let's get right into it. Let's start with the basics because I'm sure most of you have gotten this far in your life without understanding what actually is happening on your tax return. First, we'll take into account gross income. Think about this as your W-2 income, 1099 income minus business deductions, dividends and interest, or capital gains as a start when you hear gross income. From here, you're gonna subtract any adjustments you may have. So common adjustments include half of your Social Security tax, your self-employed health insurance premiums, and student loan interest. After those are subtracted from your gross income, you're left with adjusted gross income, or AGI. And then after that, we subtract either your standard deduction or your itemized deductions, whichever is greater. So unless you have a large mortgage or you're a large donor to charity, you can safely assume that you take the standard deduction as the law stands today. Once you subtract this deduction, you arrive at taxable income. So from here, you have the tax calculation, and that kicks in based on your income level and your filing status. So we have a marginal tax rate system, which means the more you make, the higher your top tax rate is. Now there's a common misunderstanding here. If you have income that pushes you into the top tax bracket, for example, you don't pay that rate on all of your income, only on the amount that exceeds the previous bracket threshold. And the last comment on the tax calculation is that different filing statuses will drive different income thresholds when applying the different tax rates. So getting married, for example, in the year will change how your income is taxed since you'd be filing as married instead of single. All right, so once we have the income tax number, we can subtract any tax credits, such as the child tax credit, from that tax number. And remember, credits, unlike deductions, they lower your tax due dollar for dollar. For some agents, we'll add in the Social Security taxes after that to get your total tax. And from here, we just subtract any prepaid taxes, such as estimated tax payments that were paid throughout the year. And at the end of all of that, if you paid in more than you owed, you get a refund. And if you didn't pay in enough, you have a balance due. And that sums up the federal individual return. And then you'd also need to file a state and local return as well. There are several major tax changes you'll experience when you switch from a W-2 employee to a 1099 contractor, and understanding these changes will set us up to be able to talk through the strategies to save on taxes a little bit later on. All right, so number one, no one is withholding taxes for you anymore once you're paid on a 1099. So this includes two types of taxes common to most workers, including income taxes and Social Security taxes. So number two, assuming you are taxed as a sole proprietorship in your first year, 100% of your net income will be subject to double the Social Security tax that you had to pay in while you were a W-2 employee. This is because employers pay half of the Social Security tax on behalf of their employees, and 1099 contractors are responsible for the employee and employer side of the Social Security tax. This alone comes out to be roughly 15% on top of your income tax. And then lastly, number three, 1099 contractors can deduct ordinary and necessary expenses against their income to lower their taxable income, whereas employees have no ability to deduct expenses that they were not reimbursed for by their employer. So in summary, becoming a 1099 contractor requires more planning to make sure you are as efficient as possible on lowering your taxes and making sure the money is available to be paid when the taxes are due. Next, let's discuss whether or not a real estate agent should use a CPA. The short answer is that a CPA is absolutely necessary for saving money on taxes as a new real estate agent. Not to mention the laws change so frequently now that you need someone keeping an eye on those adjustments and recommending the correct course each year. Now, I'm sure I'm a little bit biased on this subject, but trust me, the money you pay to a CPA will be a fraction of the money that they'll be able to save you, not to mention the headaches. I would say shop around and interview several before making a final choice. Look for a CPA who is forward-looking and eager to help you plan for your future rather than just looking to the prior year to know what to put on the tax return. Next, let's tackle the question of should I set up an LLC for my real estate agent business? LLCs provide two major benefits for what most will consider a very cheap cost. In Kentucky, for example, you can have an LLC set up in about a day for $300, and then the ongoing fee to the state is roughly $200 a year. And that pays for itself for the vast majority of agents. So the first benefit is liability protection. For the real estate agent industry, this doesn't apply as much because you are the one doing everything in your small business. For that reason, it is smart to look into an errors and omissions insurance policy on top of your LLC. Now, if you were to start renovating houses and flipping them, then the liability question changes drastically, given that a lot of the work there will be contracted out to others, and the LLC would provide more protection there. The second major benefit of the LLC is the tax flexibility. Basically, there's no tax law written for the LLC, as it is a fairly new invention in the tax law world. So an LLC elects how it would like to be taxed and has the ability to make that decision retroactively once the agent knows their final numbers. For real estate agents, the tax treatment consideration of the LLC is normally between a sole proprietorship and an S Corp. Basically, the sole proprietorship is the simplest route, but you pay the most in taxes, while the S Corp is much more complicated and costly, but can easily save you enough in taxes to justify those added costs. The main thing to consider is that the tax flexibility only starts once you have the LLC in place. Any income earned prior to the LLC start date will be treated as income through a sole proprietorship. So it's important to think about setting up the LLC before your first commission check comes in, if possible. Again, talk through this with a professional before making any decisions because each situation is different. For example, a part-time agent may not need to set up an LLC because the tax savings will never be enough to justify an S Corp conversion. In the prior section, we discussed tax flexibility and how the LLC allows you the option to have your LLC taxed as an S Corp if it makes sense. So how do those tax savings come into play practically? Basically, the S Corp tax structure allows us to legally lower the amount of Social Security taxes we pay. So in the default tax structure of a 1099 contractor, the sole proprietorship pays 15% Social Security tax on 100% of the net income. Remember that this is on top of income taxes. But in an S Corp, you only pay Social Security taxes on what you decide to pay yourself as a salary from the S Corp. So let's talk through a quick example to demonstrate this. Let's say you make $100,000 after deductions from real estate agent activity. As a sole proprietorship, you'd pay roughly $15,000 in Social Security taxes, and then you'd also have income taxes as high as 24% depending on your filing status for that level of income. Now let's say you convert this activity to an S Corp and you pay yourself a $50,000 salary. So now only the salary is subject to the Social Security tax, and the other $50,000 of what's called owner distributions escapes that 15% tax, and this saves you about $7,600 in taxes. So almost $8,000 in extra positive cash flow would be beneficial for any agent out there. Maybe you want to use that money to max out a health savings account plan, or you and your family could go use that money for a vacation down to Mexico. However you choose to enjoy those savings, it's a nice option to have those dollars positively affect you and your family rather than go to the government. All right, so there are two things to consider on the S Corp front despite the benefits. The salary you choose for your S Corp to pay you has to be, quote, reasonable according to the case law that is currently on the books. Now this is a gray area, and we normally suggest a salary of 40 to 50% of your net income. This still provides tax savings, but it also gives you the ability to argue it to the IRS if you ever needed to. The other thing to consider on the S Corp has to do with the added professional fees and reporting. The S Corp conversion adds a new tax return to the mix, as well as quarterly payroll tax returns. This is an added cost from your accountant, and you want to make sure that the tax savings over several years more than justify the added CPA cost before making the switch. Okay, let's move on to tax deductions. So I've attached a list of all the possible tax deductions for real estate agents for you to look through whenever you have some time. The main thing I want to go over in this section is how to understand the tax savings from a specific purchase. So the equation to find your tax savings is simple. You multiply your deduction amount by your effective tax rate. And think of your effective tax rate as the average rate of tax you pay on all of your income. So you can calculate this as your total tax divided by your taxable income. So for example, let's say your effective tax rate is 18% and you just spent $500 on an iPad that you'll exclusively use for real estate. That $500 purchase will actually save you $90 in taxes, so you get a nice discount on the iPad purchase. The other general rule I normally have clients think about when it comes to deductions is think of them as anything you needed to spend money on to make more money. So your realtor dues, that's an obvious one because those allow you to actually do the work legally. But there are other ones that are less obvious. So one example is a gym membership. This will most likely not count for a real estate agent because it's not ordinary and necessary for your business. One of the major deductions for realtors has to do with deferring out income using retirement accounts like simple IRAs or solo case. These can be set up to allow you to take a portion of your income and place it in a tax-deferred retirement account for the future if you have excess cash and would rather have the tax break now. That money will be taxed once it is distributed in retirement. So the other thing to consider is your tax rate now versus your tax rate at retirement age. Are you in your highest earning years right now? Do you believe tax rates will be lower or higher in the coming decades? Thinking through these questions will help you decide which account is best for you. For these discussions, I would suggest speaking with a CFP who specializes in planning as well as investing services. One last note on the deduction subject is tracking those expenses to make sure you do not miss out on any tax savings opportunities. The best way to do this is use a separate bank account and credit card for your real estate activity. This way you can plug those numbers into your tracking software and know that all of your deductions are being captured and categorized. I cannot tell you the amount of times I see agents commingle business and personal transactions in one account, and they inevitably miss deductions because they can't remember if that Starbucks charge was for a business or a personal meeting. Having a dedicated credit card and debit account for your business helps with the expense tracking, and it also comes in handy if you're ever to be audited, because you could easily pull statements supporting your transactions that were reported on your tax return. Now for receipts, the rule is to keep those in your records for at least 3 years. I'm mostly seeing real estate agents store these digitally, and your CPA does not need to see those. You can just send your CPA the summarized profit and loss statement, but you will want to make sure you have access to the receipts if the IRS ever inquired about those. Deductions are one of the most advantageous sides of being a real estate agent. Anything you spend for your business lowers your taxable income and therefore saves you real money on your taxes. So figure out a process that works for you on the tracking side so that you can easily maximize your tax savings. And your CPA might also cut you a deal if your records are buttoned up nicely come tax time. All right, let's talk about estimated taxes. So since no one is withholding taxes for you, it is up to you to pay those taxes in either throughout the year or all at once at tax time. And if you choose to wait until tax time, know that there may be a penalty for not paying in enough tax throughout the year. Thankfully, the penalty is not that severe, so I do see a good amount of people just pay it for the opportunity to use more of their money throughout the year for investments. The general rule for estimated payments is to pay in at least 100% of the tax from the previous year throughout the current year to avoid penalties. So for example, if you had a total tax of $10,000 last year, you should expect to make quarterly estimated payments of at least $2,500 each quarter to avoid penalties. The other thing is to have your CPA adjust these payments depending on how your year is going. So if your business has doubled since the previous tax year, then the estimated payments you were given when the return was filed are not enough to cover the tax. So just make sure you're working with a proactive CPA who is working with you a few times a year to adjust these estimates as needed. And you can either mail these payments in, or you can create an account on the EFTPS website to make these payments electronically. And remember, your tax refund or tax due at tax time is a result of your tax minus your estimated payments. So trying to be as accurate as possible with the estimates is important if your goal is to have as close to a $0 balance due come tax time as possible. All right, for the last bit here, I'm just gonna list out the most common mistakes I see real estate agents make when it comes to taxes. The main one is the lack of an LLC. For a lot of agents, it's going to be worthwhile to set up an LLC at the beginning to make sure you have access to that tax flexibility if you need it. The next mistake is a lack of quality partners surrounding them. Remember, as a 1099 contractor, everything is up to you. For that reason, develop a good working relationship with a CPA, a financial advisor, an attorney, and an insurance agent. Building this team will greatly benefit you and your business. Honestly, having this set up closer to the start will help you avoid most of the major pitfalls because you'll be able to lean on the expertise of those around you. Lastly, nail down your process for income and expense tracking early. Getting this part down from the start will help you avoid spending hours on the back end trying to build a profit and loss statement from personal bank accounts and credit card statements. It will also ensure you aren't missing obvious tax deductions because they're buried with some of your personal expenses. I really hope this was helpful for you and that now you feel empowered to tackle this part of your business. Remember, taxes are going to be your largest lifetime expense, and considering all the ways to legally reduce your tax burden is going to fast track your wealth building journey. If you have any further questions, feel free to reach out to me on Twitter at guess_Jordan, or you can visit my website, trusted-cpa.com. Thanks so much for watching, and best of luck to you guys in the future.